Here's a 190-year-old trading house, controlling everything from Toyota's biggest dealer network in Southeast Asia to the Mandarin Orient hotel brand. And the market is pricing in zero growth rate forever. That's Jardine Matheson Holdings, LSE ticker JR, SGX ticker J36. Today I'm going to walk you through the stock from the ground up, the business, the numbers, the moat, the risks, the valuation, and at the end, my verdict. Let's get into it. Quick agenda for today. 7 things I want to cover with you. 1. The business. How a conglomerate that owns almost nothing directly actually makes money. 2. The numbers. 9 years of underlying profit versus the GAAP track. 3. The moat. What protects this business and what doesn't. 4. The opportunity. Why the market is pricing in zero growth. 5. The risks. The stuff most channels skip, including one I got wrong the first time and had to correct. 6. The valuation, what it's actually worth. And 7. The verdict, would I buy it and on what terms? Let's start with the business. Jardine Matheson is not an operating company. It's an investment holding company. That distinction matters more than anything else in this video. JMH owns controlling or influential stakes in 7 operating businesses spread across Hong Kong, China, Indonesia, Singapore, and Vietnam. It doesn't build cars. It doesn't run hotels. It allocates capital to the people who do. In FY 2025, the parent company pulled in $983 million in dividends upstream from those subsidiaries. That's the actual cash JMH itself gets to work with. Over the last 5 years, it's recycled about $8.6 billion of capital out of lower quality assets and into higher quality ones. And as of January 2026, it now owns Mandarin Oriental 100% after taking it private. JMH doesn't make cars or run hotels. It allocates capital to the people who do. And since December 2025, under a new CEO, that's become an entire strategy. Here's where the profit actually comes from. 7 segments, but one dominates completely. Astra International, the Indonesian auto, agribusiness, and heavy equipment conglomerate, is 46% of underlying profit, or $787 million. Hong Kong Land is 14%, $245 million. DFI Retail Group is 12%, $209 million. Jardine Pacific is 11%, $191 million. JCNC excluding Astra is 9%, $155 million. Zhongxing is 4%, $63 million. And Mandarin Oriental rounds it out at 4%, $68 million. Astra alone is nearly half of underlying profit. Indonesia risk IS Jardine Matheson risk, which is exactly why the Martabe gold mine dispute, which I'll get to in the risk section, matters so much. Now let's look at 9 years of financials. FY 2017 through FY 2025. Underlying profit, the number that actually reflects operating performance, has been remarkably stable. $1.54 billion in 2017, dipping to $1.09 billion in the COVID year of 2020, and recovering to $1.68 billion by 2025. That's a modest 2.7% annual growth rate over the 2021 to 2025 stretch. Now look at reported GAAP profit, and this is where most investors get confused. $3.9 billion in 2017, down to a $394 million loss in 2020, a $468 million loss in 2024, then back up to $1.1 billion in 2025. 2 loss years in 9. People see that and assume the business is falling apart. But those swings are driven almost entirely by non-cash investment property revaluations at Hong Kong Land, plus impairments, not by anything happening at the operating level. I'll walk through exactly why that matters in a couple of minutes. Revenue tells a quieter story. $38.7 billion in 2017, down to $34.2 billion in 2025. This isn't a growth story. It's a cash flow and capital allocation story. Let's talk about the balance sheet, because it just flipped And this is the part one had to go back and correct after I first published my research on this stock. The JMH parent company, not the consolidated group, the parent balance sheet specifically, ended FI 2025 with $41 million in net cash. That's a swing from net borrowings of $1,312 million just 1 year earlier, in FI 2024. Now, separately, the consolidated group's net borrowings, which includes fully consolidated subsidiaries like Astra and Hongkong Land, even though JMH doesn't own all of them, sit at $2.72 billion, down from $7.32 billion. Two different numbers, both pointing the same direction. But don't confuse them. I did in an earlier draft, and a sharp-eyed reader caught it. NAV per share is $98.19. The stock trades at $62. That's a 37% discount to book. And the underlying payout ratio is 41%. DPS of $2.35 against underlying EPS of $5.72. Plenty of headroom. This isn't a debt story anymore. It's a discount NAV story, backed by a parent balance sheet that just swung to net cash and a $250 million buyback program, approximately 93% executed. What protects this business from competition? Let me be direct. It's a mixed picture, segment by segment. Strong infrastructure and efficient scale. Hactle's air cargo terminal at Hong Kong International Airport and Jardine Schindler's elevator maintenance contracts. These are markets too small to rationally support a new entrant. Strong governance and capital allocation. A 190-year history of recruiting world-class boards. The new CEO comes from PAG Private Equity. The new managing director of investments comes from Advent. Independent directors include a former HSBC Group CEO. Mixed real estate and brand through Hong Kong Land and Mandarin Oriental. Genuine intangible asset moats. A central Hong Kong address, an ultra-luxury hospitality brand. But both are capital-intensive to defend. Weak DFI retail in thin-margin grocery and health and beauty. It competes directly with A.S. Watson, a CK Hutchison subsidiary, in commoditized categories with limited pricing power. At risk, Astra's auto franchise against Chinese EV entrants. BYD and Wuling are taking share in Indonesia's fastest-growing segment. That's a genuine long-term brand relevance risk sitting inside the company's single largest earnings contributor. So why is this on my radar? Because the market appears to be pricing in essentially zero growth, and I think that's becoming harder to justify. For things change. First, new CEO Lincoln Pan, appointed December 2025, ex-PAG Private Equity, explicitly accelerating the shift from an owner-operator conglomerate to a lean, engaged investor. Second, the parent balance sheet swung to net cash, and there's a $250 million buyback, roughly 93% done, with a larger $500 million target flagged for 2026. Third, Mandarin Oriental was privatized at a 52% premium to its last unaffected price. That's real-world proof the underlying assets are worth more than the market gives JMH credit for. Fourth, a 6.44% 5-year dividend CAGR. I want to flag this specifically because I originally mismeasured this using a 4-year window and got 4.1%, which would have failed my framework's threshold. The correct 5-year measurement, 2020 to 2025, is 6.44%, a genuine, underappreciated compounder track record. At $62 a share, the market is pricing in essentially zero growth forever. Our base case is 6.4% EPS growth through 2030. That gap is the whole thesis. Okay, let's be honest about the risks. This is the part most channels skip. I'm not going to skip it. And I'm going to be transparent about a mistake I made here too. High severity. The Martabe gold mine, Astra's PT Agincourt Resources license, was revoked in January 2026. Some press reports in March suggested operations had resumed. I initially repeated that. It was wrong. JMH's own Q1 2026 Inter-Management Statement, published May 22nd, explicitly says the stoppage was still ongoing. Always trust the company's own primary filing over a secondary press report. Lesson learned and corrected here. High severity. The $2.4 billion IMED radiology acquisition, JMH's first major move outside Asia into Australian healthcare, size at roughly 13% of its own market cap, and proven integration under a management team that's been in place for less than a year. Medium. Chinese EV competition eroding Astra's core four-wheeler franchise, JMH's single largest earnings contributor at 46% of profit. Medium. The Zhongxing deconsolidation, a roughly $63 million a year profit contributor, is gone from FI 2026 after a $732 million impairment and a change in board representation. The exact timing and trigger are worth scrutinizing closely. I go through this in detail in the full written report. Medium. The Hong Kong and China property cycle. Hong Kong land, 14% of profit, remains exposed to a China property overhang, despite early signs of a Hong Kong leasing recovery. I need to spend 1 minute on this because it's what confuses people the most about this stock. In FI 2024, JMH reported a headline GAAP loss of $468 million. Read the headline alone, and you'd think the business fell apart. But underlying profit, what the operating businesses actually earned, was $1,518 million. A profit, up from FI 2023. Same year, opposite conclusion. The gap is driven by a $2,213 million negative swing in Hong Kong land's investment property fair values, plus impairments, including the $732 million Zhongxing write-down in FI 2025. Under IFRS, these non-cash items flow straight to the P&L as expenses. No cash left the building. The gap between headline and underlying was actually larger than underlying profit itself in FI 2024. Always read underlying profit, not the reported headline, for this stock. 3 ways to value this company. 3 methods that converge on a similar answer. Method 1, owner earnings DCF, using minority interest adjusted underlying profit as the earnings base and a 10.5 to 12.5% discount rate, reflecting the geopolitical and regulatory risk premiums this framework applies to Asia-exposed conglomerates. I get a base case of $88.69 per share. Bear case, $47.23. Method 2, analyst consensus. 8 analysts, strong by rating, average target of $90.79. That independently triangulates within 2% of my own base case DCF, which gives me more confidence in the number. Method 3, EV/EBIT multiple. JMH currently trades at 10.1 times, roughly in line with its own 5-year average of about 9.5 times, and modestly below an approximately 11.0 times peer median for Hong Kong and Singapore conglomerates. Blended fair value across all 3 methods, approximately $88 per share. At $62 today, the margin of safety is approximately 30%. Here's the number I find most interesting in this entire analysis. At $62 a share, using a 10.55% discount rate and a 2.5% terminal growth rate, I solved backwards to the growth rate implied by today's price. The answer, 0.1%. Essentially zero forever. My own bottom-up, segment-by-segment base case forecasts a 6.4% EPS CAGR through 2030, driven by buybacks, the IMED acquisition, and a Hong Kong land and DFI retail recovery. If management delivers even half of that, this stock is meaningfully mispriced today. If they deliver none of it, the market is already right. For things I'm watching that could close the gap between $62 and fair value. Catalyst 1, the new CEO's first full-year guidance, expected in Q1. Lincoln Penn's FI 2026 strategy update will be the first real signal on capital allocation priorities under new leadership. Catalyst 2, buyback continuation, which is ongoing right now. JMH has been retiring shares below NAV, and every buyback at a 37% discount is instantly accretive to per share intrinsic value. Catalyst 3, Martabe resolution, in either direction, likely in the 2026 to 2027 window. A confirmed restart or a confirmed permanent closure both remove uncertainty. The market hates the limbo more then it would hate either actual outcome. Catalyst 4. IMED integration proof points. Ongoing. Early evidence the $2.4 billion Australian healthcare bet is earnings accretive would validate the ex-Asia diversification thesis. Here's my base case EPS forecast for FI 2026 through FI 2030. FI 2025 actual, $4.98. FI 2026 estimate, $5.28. FI 2027, $5.66. FI 2028, $6.08. FI 2029, $6.53. FI 2030, $7.02. That's a 6.4% compound annual growth rate, driven by buyback-fueled share count reduction and Astra volume recovery, Hong Kong land and DFI retail margin normalization, and IMED accretion starting FI 2027, partly offset by the loss of Zhongxing's roughly $63 million annual profit contribution. Quick comps check against a global conglomerate peer set. JMH. EV/EBIT 10.1 times, PE 12.4 times, dividend yield 4.2%, 5-year average ROE 9.8%. Swire Pacific, 9.6 times, 10.8 times, 5.1% yield, 8.2% ROE. Hutchison, 11.3 times, 13.9 times, for 0.6% yield, 7.1% ROE. Jardine CNC, 8.9 times, 11.2 times, 3.8% yield, 14.3% ROE. Peer median, 9.6 times EV/EBIT, 11.2 times PE, for 0.6% yield, 8.2% ROE. JMH trades roughly in line with peers on EV/EBIT and PE, but that headline comparison masks the real story. Strip out the conglomerate discount to NAV, that 37% gap, and the underlying operating businesses are demonstrably cheaper than the multiple alone suggests. So, would I buy Jardine Matheson at $62? My verdict, conditional. Half position under the framework's active tripwire override. Here's my thinking. The bull case is strong. A 30% margin of safety to blended fair value. Buybacks retiring shares at a 37% discount to NAV. A new CEO bringing the first credible capital discipline in years. And a 6.44% 5-year dividend CAGR that now comfortably clears my framework's Engine A hurdle. But the bear case is real too. The Martabe stoppage is confirmed ongoing as of the May 2026 filing. Not resolved, whatever the March press report said. Astra, 46% of profit, faces genuine Chinese EV share loss. The $2.4 billion IMED bet is improving and outside the company's core competency, and a conglomerate discount has persisted for over a decade. There's no guarantee it closes on any particular timeline. My framework has a capital preservation rule that caps this at a half position, while Martabe remains an active, unresolved tripwire. I'll revisit for a full position on confirmed resolution. In either direction, restart or permanent closure. That's the JMH Deep Dive. If this was useful, like and subscribe. I do these detailed stock analyses every week for the JC Project Freedom community. Drop a comment below. Does a Martabe overhang change your view here? Or is a 30% margin of safety enough for you already? I'd love to hear. This is not financial advice. Everything I share is my own research for educational purposes. Do your own due diligence before making any investment decision. See you in the next one.